Mitch on the Markets, a conversation about the issues and trends affecting investors with Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management. Our regular weekly get-together with Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management, and we really appreciate Mitch's time, having him come here every week and sit down and kick these markets around with us. Mitch, I guess the most obvious question right off the bat, is this a bear market, technically speaking?
Well, there is a definition of a bear market, which is basically a 20% pullback from a peak. So based on that definition, you would have to say that the S&P 500 and the Dow have entered bear market territory. That being said, one of the best times to invest for the long haul is when you're seeing a pullback in equity prices. And I continue to believe that the current market conditions are representing a near-time low, and that now is an excellent time to be adding money to the equity markets. At the end of the day, you have the same three factors weighing on the market. You have a decline in residential investment. That's essentially housing, building houses. You're looking at about 20% annualized year-over-year decline in residential investment. That's primarily going to hit in the second and third quarter of this year. Additionally, you have increasing oil prices, which is putting this very, very dangerous tax on consumption. And you have problems in the credit sphere. I continue to believe the Fed's going to take care of the credit problems, okay? So those are going to be alleviated. Oil prices are going to moderate, and housing is going to bottom. And when those things happen, the market is going to be moving upward very, very substantially. You have to understand, though, that the market is a forward-looking instrument, and it's going to be moving up far before you start seeing the economic and macroeconomic data that supports the move. The same way the market started moving down before you really saw the macroeconomic data take a turn for the worse, the market's going to be moving up before you start seeing the macroeconomic data. So, where are we? We have probably a little bit lower to go, but generally speaking, the risks are weighted in such a way, and the market has sold off enough that now is an excellent time to be putting money in equities. You have negative real rates of return on fixed income investments. You have effectively a bottoming on the housing cycle. And I fully believe that now is an excellent time going forward, and I expect the S&P 500 to go down a little bit more, but to eventually rally towards the end of the year. I don't expect that this bear market is going to be worse than the last bear market. I think it's going to be much, much better, and I think we may have already hit the lows.
All right. Was much of the recent market sell-off of last month due to the market factoring in weak second quarter earnings and maybe lowered third quarter and fourth quarter earnings?
No, what's driving the market right now are macro factors. So what's driving the market are oil prices, energy prices, the concern that energy is going to continue to spike upward, and the concern that credit problems are going to continue to expand. What's driving the market is the problems that you're seeing in the regional banks. Regional banks, they loaned out a lot of money to construction. People build condos, constructions, houses, things of that sort. They're going to have defaults on some of those loans. And the concern is that as those defaults eat into their capital base, they're going to effectively pull back on their lending to corporations and to smaller companies that really depend on the bank loan side of things to finance growth effectively. Most larger companies like GE and things of that sort have broader access to the capital markets. Most small companies, most non-public companies, when they want to grow their plant, they turn to the bank and they say, listen, you should give us an asset-based loan based on this equipment that we're going to be purchasing. And the concern is that the problems in the credit sphere, because of the decrease in housing prices, is going to affect a clampdown in lending. And you have seen some pullback in lending, but this is par for the course for the economy. And in these periods when you do see issues with banks, it's actually a very, very good time to be buying the market. It's very, very important to understand there's not a credit crunch going on. If there's a credit crunch going on, what you see going on is you don't see capital available to be invested in these financial institutions. And that's not what we're seeing at all. The world is awash in capital. In fact, there's maybe too much capital and not enough opportunities. And the result of having too much capital and not enough opportunities is pushing down potential returns and causing people to find and put money into commodity space where they really shouldn't be looking. But generally speaking, you have a slowdown in the corporate lending arena, which the danger is it's going to weigh on the economy. What's helping the economy stay out of a recession, the bear market is determined by the 20% pullback, but it's not a recession yet. It's determined by the quarter-to-quarter growth rates. And what's helping it stay out of a recession is the fiscal stimulus and the Fed's ability to address this credit crisis.
Well, the Fed says that it may give banks more time to access emergency funds. What kind of an issue is this for the stock market? Important one?
It is a very important one. If you go back and you look at really, really bad periods in the equity markets, what happens is there's usually a credit crisis, but the people in charge of the central bank make the opposite move. So instead of making liquidity available, they raise interest rates while there's this demand for capital, essentially. In this case, you have a Fed that's very, very experienced. They're doing the right moves at the right time. And I put my trust that they're going to provide enough liquidity to the system that it will eventually recover effectively. So I'm not concerned with a massive worsening in the credit arena. I actually think that a lot of the problems now are bottoming, and I think the market is in a process of bottoming as well.
You know, there's still a lot of talk out there. You mentioned the economy a moment ago. Stagflation, inflation. Right. Some people say we don't have the typical stagflation. They refer to it as stagflation light.
Right.
The question, though, is until the Fed gets this stagflation conversation or argument squared away, is that what's prohibiting the market from turning upward and sustaining upward momentum?
What's prohibiting the market is these three factors. You have to ask yourself, are these factors, the oil prices, the credit crisis, and the decline in residential investment, going to get better or worse over the next 2 years, the next 9 months, the next 6 months? They're going to get better. As they get better, the market's going to be heading higher. This issue of stagflation, we're in a stagflation environment. Outside, if you look at core inflation, excluding food and energy, and people will say, well, why are you excluding food and energy? Because they tend to be less volatile over time. You don't see very, very strong inflationary pressures. You see inflationary pressures on oil, but you see things such as apparel, electronics goods, a lot of capital equipment actually declining in price due to globalization and due to external competition, and also due to an increase in information technology. So we're not, in fact, seeing the same inflationary pressures that we saw in the 70s. Here's what's happening. The economy's slowing. There's some issues on the credit side. Oil prices have spiked up a little bit. Markets sold off a little bit. It's par for the course. You stay the course. You stay invested. You look to the long haul, and you look over a 2 to 5 year period, and the market will be substantially higher than it is currently.
Another interesting market perspective from Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management.